Hello, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, your host. We're looking at the S&P 500, and we've been talking for some time now about this expanding triangle. The way expanding triangle works is you got A, B, C, D, or D, E, and then a wave 5. There's a couple possibilities here. One possibility, although I think it's remote, is that we've topped. So this is the top right here. And, we're going to make our way down to here and then rally and then sell off even more. That's one possibility. Another possibility is we're just going to come down here to this support area. That's right there. And then begin to rally. No, can't make it. Rally back up. Complete D. This would be D. And then make our way down in wave E. And then rally to a fifth wave high. That's another possibility. And I'd say the other possibility is this is already D, and we just kind of make our way down here to E. And then rally. So they're all sort of the same. Only one takes you to higher prices and then lower. The rest of them just take you to lower prices until you get down to here and then higher. So, depending on what your tolerance for risk is and how much drawback you want to see, this move from here down to here is about 10%, 12%, something like that. So if you can tolerate that kind of drawdown in your 401k, then you might want to stick with it. If not, you could step to the sidelines, see how much further we go down, and then get back in. As you can see here, this took, the way these are, they alternate. So if this is, one of the reasons we might not think this is over is if this is D here, then what you do is you go to B, and let's see, let's get a trend line like this and just measure how long this is. So that is 168 days. So, you tend to get a relationship like 1.62. So 168 times 1.62 is, let me just do that real quick. That's 272 days. So what that could mean, the reason this is not over is because 272 days, that's 210 right there. So maybe we don't get a full 262 out of it. That's 270 right. That's about 270 right there, which that'd be the end of September. So maybe we don't get a full 1.62 out of it, but we could get more than what we've gotten so far. Right now, that is from low to high is only 125 days, which is not more than this one, which was, what did I say, 168 from low to high, from here to here. Yeah, 168 days. So, it stands to reason that this D wave might not be over just because we haven't gone enough days yet. We haven't even gone the same number of days. It's only 125 days. So, and then right in here so far is 154. So maybe we spend, this week and maybe even next week coming down into this support area, and then we spend about 6 or 8 weeks rallying into this area, and maybe we get to about 220 days, something like that. So we'll see. I mean, that's obviously that's not the truth. That's just what's typical. And the same kind of relationship between these days. So if you measure this from high to low, that's 70 days. So 70 days times 1.62, 70 is 118 days. So let's see what this is right here. From high to low is only 98 days. So maybe that's the ratio. What did we say this one was? 70 to 98. What's that ratio? That's 1.4. So 100 and what did I say this was? I can't remember what these numbers are. I apologize. Probably should write them down. This is 168. So 168 times 1.4 is 235 days. So 235 days would be right there at the edge of this rectangle. Here, let's just make a mark here. So 235 days would be right about here. So maybe we head up into there, and that's, what is that? That's mid-August. So I could totally see this going to mid-August. That wouldn't be unusual, I don't think. Oh, sorry about that. It's wanting to resize my graph, and I really don't want to do that, but I'll do that anyway since it's wanting me to. All right, so that's the S&P 500. Let's look at the 10-year yield. A lot of action last week in the bond market. Remember, the thesis we're working off of is that this is an important low. This is a rally off the important low. This is the first retracement off that important low. And we've got this area right in here that we've drawn this yellow box on, and that's where we're expecting, now that the market kind of crashed through this area, it came down, went back up, crashed through, retested, and then crashed even harder. So my expectation is that the bond market, the bond market's rallying right now. Okay, so bond prices are going up, but that means the yields are going down. So I'm expecting the yield to come down here below 2 before it settles. And then if it starts to rally there, then this next move could be a wave 3. So wave 3s are very long and powerful, and definitely if you're going to be in a market, wave 3 is the place to be. So, all right, let's look at the 13-week Treasury. Last week it was just starting to bust out of that range we talked about, and you can see it still has not busted out, which is kind of interesting. So what I said was the Fed's not likely to do anything until we get either above this range or below this range, and we're really just still kind of hanging in there. So don't look for the Fed to do anything while we're kind of in this range. All right, volatility. Probably should have looked at volatility first. Volatility continues to be low, although rallying somewhat in the last couple of weeks, especially last week. Excuse me. But volatility looks to be somewhat contained for now. We could get a spike up a little higher, but I don't know. I'm not expecting that. I'm expecting volatility to maybe just stay in this area, maybe slightly higher, but not dramatically higher from where it is right now. So we'll see how that goes. Looking at some of these other countries, Germany, I think it's, we talked about whether this is retesting, whether it's going to come down and retest this downtrend line and then bounce off of it and go up. I think at this point it's looking more like it's looking pretty weak, like it might fall through it. I think Japan's looking more on the weak side. UK's looking more on the weak side. So none of the other major markets look much. They look weaker actually than the U.S. market. So I don't know that that's a great place to hide. I've heard people talking about that there's that you need to get out of the U.S. market and get into other markets, and maybe that's true. As we're going to look at the euro in a second. In fact, let's just do that now. Let's go look at the euro US dollar. You can see here, let me open this up a little bit to a monthly chart. Well, this is all the data on the euro, so just go back to the weekly. So this is a low on the euro. Same kind of thesis we have in the bond market. We got this rally up, and we got this long protracted pullback into support. Now, that's the huge picture, right? That's the really big picture. But then we got this smaller, like a subset picture, where you had this rally up and another protracted pullback, but off of this rally up. So in other words, we could be looking at a wave 3 here. So this would be a 1, 2, 3, where this would be wave 1 of 3 starting off here. But I don't think we're there yet. Let's zoom in a little bit and we can look at it a little closer. Yeah, I've got this little trend line here, and the dollar's a little bit more clear. It looks like the dollar's got some more up and down to go, but it looks like maybe the euro wants to kind of pull down, maybe pull back up, and then pull down again. You know, with a price maybe just below this trend line, but then I think there's going to be a great opportunity to get long the euro. I was just looking at the other day, just to kind of put the opportunity in perspective. Just if you trade back up here to the, well, I can't remember if I drew it on here or not. Let me see. No, I didn't draw it. Let me delete some of this stuff and I'll draw it real quick and I'll show you what I mean. So one of the things you can do if you think you're in a wave 2, you can go and you can measure the wave 1. So you can use Fibonacci. So let me do that real quick. I want just to show you a little cool trick. So I'm going to go to Fibonacci retracement, and I'm going to get right there. I'm going to go to the low, so from high to low. And then what we want to look for is we want to look for the 262, the 2.62. So a lot of times the wave 3 will be a 2.62. So you can see the 2.62 is way up here at 1.6293. Now this could take, 2 years or more, 3 years maybe. So, you can't be impatient on this trade, but you can see that our risk is essentially non-existent. I mean, we catch the bottom or near the bottom. The reward is way up here. So just to kind of put that in perspective, I was looking at buying a full-size contract, which is 100,000, and it'd be like a $400 or $500 risk. But if it actually goes all the way to the 2.62 target, so you'd have let's say a $500 risk, but then you have the opportunity to make like $40,000. So I mean, it's just these wave 3s are huge opportunities. So you might want to take a look at that. I think the euro looks prime for that kind of trade. Now, again, you got to plan on being in the euro for like 3 years. So if you don't have that, if you're going to need that money for 3 years, I mean, you're obviously not going to get all the way to that target. But I still think we've got a low risk entry setting up here on the euro. Let me just go to a shorter time frame, like a 4 hour. A lot of times I use a 4 hour, and you can see here, it's kind of chopping up and down, and you can see that we like next week we'll probably get some sort of sell off coming down this way, and then we might get another rally like this, and then like this, and then like this. Maybe not to a new high. You take that off. Maybe to like right there, and then probably break below this trend line slightly. Maybe something like that. And then, enter in here somewhere. Now, we've talked about it before on how you enter. You wait for, a close above the high of the low day. So get back on a daily chart. Get back on a daily chart like so. I zoom in a little bit. You can see this is a low day. Well, no, actually the low day is right here. So we would need to close above this high before we said, okay, we're going to be long the euro. So we don't have that yet. The Euro's rallying. I think it's probably going to sell off a little bit next week to a slightly lower low. But you can always watch these candles every day. And if you get a break above the high of the low day, go ahead and enter. I think that's a low risk situation. This whole triangle pattern and everything has got to be coming to an end. And you might be wrong the first time, even the second time. Don't be afraid to enter 3 times. I mean, if you lose $400 or $500 2 times in a row, but then you make 40, you're way ahead of the game. So don't worry about that. That's the key to making money in the markets, is you want to pick low risk entries. And if you'll notice, well, you can't tell from here, but if I ran a Fibonacci from here to here, you would see that this is about the 62%. So it's just flopping and chopping all around the 62% area, which is prime area for entering long trades. All right, let's look at oil. I think oil has been very interesting. Oil's finally started to roll over, and roll over it has been doing pretty dramatically. But it could be going a little further, maybe down into this area off of this congestion zone here, and then rallying back up. Again, we're looking, if you remember in a triangle, let me go out a little further to weekly. In a triangle, we're kind of looking at A, B, C, A, B, A, B, C. So we could come down into this area and then rally back up, and it could go for a long time. I mean, let's go back to the euro just for a second. Look how long the euro has been trading in this sideways market. I mean, this is some sort of triangle, and then A, B, C, and then this is a 4 or 5. So the bottom happened here, but then we rallied, and this 2, even though this is a wave 2, it's kind of ending with this triangle, and look how long that's taking. So you got to be real patient when you're waiting for these things to develop. But the thing you need to remember about triangles, let me just draw it real quick. The thing you need to remember about triangles, so let's say you've got a triangle pattern setting up like this. Whoops. I just want to give it a little bit of, even if it's not that drastic. The thing you want to remember about triangles is, let's say the trend was this direction. Okay? So this would be A, and then this would be B, and then this would be C, and this would be D, and then this would be A, B, C, D, yeah, E. Oh no, I'm sorry, I did this wrong. So this would be D, and then you'd have E. Okay, so this is the trend finishing. Okay, so this would be like a 5th wave move. Okay, so you got A, B, C, D, E. Okay, and then so what happens is you get one more push lower to a new low that takes out this low, and then somewhere in here is where you want to enter for the next move up. This will be a long move. So the good news about triangles is they're the last, aside from this last move here, it signals the end of the trend, the trend that you've been observing. So for example, let me back out of this and start over again. Okay, so for example, let's say this isn't the best thing to write on. Let me go back and let me write on maybe some white space and write on that on the profit chart. Yeah, there's not a lot of white space, is there? Is there? Let me pull up something else. What can I pull up? Let's pull up the S&P 500. Okay, there's quite a bit of white space right here, so I'll just zoom in here. Okay, so if your trend let's say your trend, your swing down was like this. Okay? And then your triangle starts to form. Right? So A, B, C, D, and then E. Okay? So just to so you can see it here. Here's the triangle. So after E, you get this thrust down to a new low, a low below this low. Now, this swing, it's possible that it only goes to right here and then continues. Okay, that's possible. But if you're looking at the chart correctly, I mean, if you identified this as, let's say, a C, this whole move is a C. Well, then what happens after C is a new 5-wave move up. So you're going to get something like, this. And like I said, the cool thing about the triangle is it tells you that you're near the end of this move. So you've got a move like this coming. I hope I haven't confused you. I probably didn't do the best job of explaining that. I'll try to find a better example. Well, I tell you what, I was talking to my son today about McDonald's. Okay, McDonald's. Let's look at it. Let's look at like a 20-year chart on McDonald's. Let's do a weekly. Okay. Well, I need to do actually. I don't even know if they have how much data they have on McDonald's. Let's see here. See, I don't have a lot of data, and I'm it's hard to see with the way this chart is. But okay, so I've turned the log chart on. Okay, so really what you're looking at is you're looking at a 1, 2, 3, 4, 5. So I was showing my son that way back here at this 4th wave low, a long time ago, McDonald's got down to like $12, and I was thinking about buying it, but I wasn't really a student of the markets at the time, and it was I remember it being a very scary time to try to buy something, so I didn't buy it. But what I've learned since is once you have 5 waves, 1, 2, 3, 4, 5, what tends to happen if a trend's going to continue, which, look, McDonald's is going to continue to survive, right? But the cool thing is I'll have another opportunity to buy McDonald's. Now, you're probably not going to believe this, but McDonald's is going back to there. Now, I don't know when. Well, I do know when. Whenever this 5th wave is completely over. Now, is it over yet? It doesn't look like it's over yet. But when this 5th wave is over, it will retrace down to this point. And when it does, that's going to be a great opportunity to buy McDonald's. So you can go look for charts like this, and if you can see the 5-wave move and find that 4th wave low, and it's a solid company, I don't know, like Hershey's, HSY, the Hershey company. Now it's a little harder here to see, 5-wave move. Maybe that's a 1, 2, 3, 4. Maybe this is the 4th wave low on Hershey. So, you could buy Hershey when it pulls back to 25. I'm trying to think of some other brands. Now, Amazon and companies like that, there's not as much data on, so it's a little harder to tell where you are with Amazon. So you can't really know for sure. Apple's been around for a good long while, and but it's hard to see, where Apple could go to. I think Apple could easily pull back into this area, somewhere between here, either this 45 area or all the way down here to this $10 area. Let's take the log off and see if Apple. Yeah, see. So sometimes this is a better way to look at it. So this, you can kind of see a 1 here. So I took the log scale off. Let me zoom in a little bit. All right. So you can kind of see a 1 here, a 2. I'm assuming this is all 3 here, and here's 4. So Apple looks like maybe it's topped, right? And it's made its A. So this is A, and this is B, and then C is gonna, it's gonna make its way down to here. So Apple is probably coming back to at least 85, and there's a possibility it comes all the way back to 45, but at least 85. So I don't know if there's people out there. First of all, you have to say to yourself, is Apple going to continue to be a force in the marketplace? If your answer is yes, then buy a bunch right here, or nibble on it and see if it starts to take off, and then buy more. But I would say by the time you get above this 120 area, you should have your full position in Apple, and then hold it for long time. It's going to go all the way back up to right here in wave 1, pull back in wave 2, and then wave 3 is going to be who knows, $500-600 maybe. So these are just this is just a different way of thinking about investing. I don't know if people think this way or not. But it's not a bad way to think about investing, especially if you just want to kind of put money in something to forget. Now, you can take riskier money and you can look for new companies that are the new Facebook, or the new not a company like Facebook, but that new type of company that is going to give you over a 3 or 4 year period a 10 times return. You can take smaller money and do that, but you can make a lot of money if you just wait and buy these companies after they pull back. And I think that's a really safe way to go. Let's see. We were on the toss charts. Did we look at everything we wanted to look at there? Let's see. Pretty much. We didn't look at gold. I think gold is getting close. I mean, we keep talking about it getting close. I think we're probably going to fall down into this area, but when we get down into this area, it's probably going to be a good buy. And you could look at silver. Sometimes silver, depending on the ratio between gold and silver, sometimes silver is a better buy. And it could be that silver could make a new low. I mean, these are pretty deep pullbacks. I would probably look for a new low here below 14 in silver. But I mean, look at the move. We're talking about it going to 22. So if you still haven't bought your physical silver and you're thinking about buying some, or physical gold, keep an eye on these charts. These are good, fairly low risk buying areas, and I think it would behoove you to keep an eye on it, especially, like I said, this euro US dollar. I mean, I just think there's a lot of opportunity there. This thing goes all the way to 1.6 or so. Just trade it back up to the old highs. You're going to make a ton of money. All right. That is it for this week, everybody. Hopefully, this has helped. We kind of got spent a little bit more time on, these patterns and what to look for. Because I think there's some opportunities coming that you want to take advantage of. And I don't think it does any good just to look at the S&P 500. I mean, that's part of the opportunity, but there's some other opportunities too, I think, that are important. Anyway, if you got any comments, make the comments in the YouTube channel, and we'll talk to you next week. Thanks, everybody, for coming in. Bye-bye.